Hello and welcome to another video on my YouTube channel. My name is Joris and today I'm going to talk about the power of compounding. And if you know my channel a bit, you know that I already discussed compounding in my video that I published on the 28th of November of last year, where I talked about the 10 rules about dividend investing. And there I said that compounding is key and that you have to have your snowball go into an avalanche. So in order to do that, you need to reinvest your dividends. And as Albert Einstein said, compound interest is the eighth wonder of the world. He who understands it earns it, he who doesn't pays it. So really important, even Albert Einstein, and my second name is actually also Albert, so that's why I like Albert Einstein. So it's Joris Albert is my second forename. And it's also important that it is what I said in that video as well. Pay off your debts, except those that let you pay less taxes. So if you have here in Switzerland, you have debts for buying your house, that amount you can deduct of your amount that you actually have on your account because that's debt, and then you don't have to pay taxes on the same amount that you have on your savings account. So that's also an important thing. Although the taxes are fairly low, still every bit counts. And until you need to start to live off your dividends, of course, because from the moment you retire and you want to live off your dividends, you can't reinvest them. So it's actually really important that you understand that reinvesting your dividends as long as you can is really important. And investing 300 Swiss francs a month after plus minus 8 years, 9 years will give you also 300 Swiss francs per month in dividends. So you need to be patient. It doesn't come overnight. And in the calculations that I'm going to do in this video, that I did for this video, I did the following. So monthly contributions is 300, and I didn't put Swiss francs or anything behind it because you can also use it for euro or US dollar. But I did them all in Swiss francs. So a stock costs then 30 Swiss francs. So you can buy 10 stocks every month, and it gives a dividend per stock of 0.1 Swiss francs every month. And I did this because of the rule of 300 that I use all the time in my head when I contribute money into the stock market. So for me, in my head, when I invest 300 Swiss francs, I want to have at least 4% of dividend return, dividend yield, so that it gives me one Swiss franc every month. And important is that for this calculation, you buy on the first trading day of the month and you receive your distribution of your dividend every 10th trading day of the month. So even if you buy the 10 stocks in the beginning of the month, you immediately receive 0.1 Swiss francs per stock on the 10th trading day of the month. So I know it's really theoretical. It's not what you are going to find ever in a stock. So it's actually more like a bond in this video, the calculation that I do. So when you buy a bond, you are certain of a certain amount of interest payment on it. And if you don't then have a bond that pays monthly, you can have more or less this calculation that I did. But when you have stocks or ETFs, yeah, it's really unthinkable that every month you will receive exactly for 30 Swiss francs 0.1 Swiss franc every month. So take for example SGPX, the ETF that my wife and I invest into every month, 300 euros on average. Yeah, then you have three fairly equal payments. In fact, I should say two fairly even payments, and then you have the payment in July that is higher, and then you have the payment in December that is lower. So yeah, the distribution that I give here is really theoretical. And then I also need to say that in the previous slide I say plus minus 8 to 9 years. Well, you can forget about that in this calculation, because now it's going to be 17 and a half years until you receive 300 Swiss franc per month in dividends. So you certainly have to be patient in this regard. And because this is because you lose compounding potential of the company. So you can't forget about that. And yes, I know that the people that focus on growth strategies with stocks, that they always say that dividends aren't good because you lose the compounding potential of the company. And I know they are right if you pick the right company. So if you pick 10 companies and one of the 10 is really a compounding beast, you will be fairly well in your in on your way to becoming a millionaire. But it's really hard to pick the right ones. If you look at the Dow Jones, the composition when it started, and you look at it now, I think there is only one company left in it. I think the oldest company that is still in it is IBM. So yeah, all the train companies that were in at the beginning of the 20th century, that's they are long gone, and the ones that are still around aren't in the Dow Jones anymore. So yeah, it's really complicated, and you really have to be switching stocks quite often. So when you have losers, sell them and try to buy new winners. And that's why I say it's more risky. And that's why I like dividend investing more, because you have the dividend aristocrats, you have the dividend kings, you know how they are performing, you know other companies that already pay 10, 15 years of consistently raising dividends. So you know the history. You also can fairly well predict the future of those companies. And okay, there also things can go wrong for sure, but it's less likely than when you only focus on growth companies. So the next numbers that I'm going to give is truly the minimum that you can expect if you invest in good ETFs and good stocks. So let's go on with it. So in the first year, this is the table of the calculation that I made. So in the first month, you contribute 300. So your total contribution is 300, of course. The monthly contribution that you did was 300. And the number of shares that you can buy, 10. Total shares, 10, because you started with 0. And then the dividend that you receive is 10 times 0.1, it's 1. And the total dividend is 1. So this goes on for a while, and then after month 8, at the end of month 8, on the 10th trading day of month 8, you receive 8 francs of dividends, and together with the previous dividends that you received, you will go up to 36, And then of course from the 36 you can take 30 to increase your monthly contribution and buy an extra share. And from that moment on, we calculate with a number behind the dot, and it goes on. And as you can see, after 9 months, you can first do an extra contribution of 30 with the dividends you received, and only 3 months later, already you can add another 30 because the total dividends that you would have received are 66.3. So you still have 36.3 left because you already took 30 here. And when you take another 30 there, you can again in month 12 buy another extra share and then increase the total dividend that you will receive in that month up to 12.2. So in this way, I continue the calculation, always looking whether or not I could do an extra investment that month. And of course, it goes up and up and up. And in month 349, after contributing 960 Swiss francs, so an extra 660 in that month from the dividends, the total contribution is 197,520. The own contribution, so only calculating with the 300, it's 104,700. And yeah, you can buy 32 extra shares. Total amount of shares is already 6,584. So yeah, the dividend, it's 1/10 of that, so 658.4. So here you can see that with this dividend, you can immediately do an extra contribution of 630, and with the dividend that was left over from the month before, after taking 660, you can do another contribution of 660. And so it goes on and on and on. And here you see in month 355, you can add an extra 990. So 690 from the dividend, although only in month 359 you will have a monthly dividend of 690.8 Swiss francs. So it always comes a bit sooner. You can also see it on this slide, of course. So you can already add 30 Swiss francs, although you only receive 9 francs of dividends, because yeah, you need to add all those numbers together, and that here amounts already up to 36. And it's the same here, but of course here the numbers are already much larger after 30 years of contributing, and you end up with this amount after 30 years. So your own contribution will be 108,000, and with all the dividends that you can invest extra, it's the total amount is 208,230. So in that month you can add an extra 990, but as I said before, when you start living off your dividends, this is no longer possible. So you will be able to earn 690.8 Swiss francs every month from your investment. And in this case, because you add the last time 990, it will be 694.1 for the rest of your life if you stop contributing after month 360. So in total dividends, you would have received 100,909.5. So the last 2 months we go above 100,000 K. And if you look at the evolution of the contributions, so you see that the total contribution in the beginning, it's really close to our own contribution, but as the time goes on, the difference becomes bigger and bigger and bigger. And in the next slide, I also put the numbers there. You also saw those last numbers in the previous slides. So it's 300 in the beginning, then it's 18,000 up to 19,860. Then after after 10 years, you would have contributed 36,000, but with the dividends, it becomes 44,160. The same for after 15 years, so 54,000 compared to 73,830. Yeah, and then at the end, you already see it. It's yeah, almost the same amount that you contribute with have contributed with dividends compared to the amount that you contribute yourself. And the monthly dividends, they go up also exponentially. So at the end, you have 690.8, but one very important point is of course 301. So that's after 17 and a half years, you are earning every month more than 300 Swiss francs, and this allows you to increase your contribution every month with the double amount that you originally started with. And from that moment on, that's why I also said it in the video about investing, the 10 rules for dividend investing. From the moment that you reach 330, so 30 is the first hurdle that you need to take, and from that moment on, you can sometimes invest a little bit extra for earning extra shares. And from the moment you are there, you are really, you're getting traction. And then when you are here, it's incredible how fast it goes. And in less than half of the time, you are at 600 Swiss francs every month that you earn extra, and that's really great. And in this case, you see, so here it's the dividend itself, and here it's the dividends that are added together. So the first time that you can actually contribute 30 Swiss francs extra. So after 9 months, the 60 months, the 60 Swiss francs was after 55 months. After 32 months, I should say. So after 32 months, you can for the first time, invest an extra 60 Swiss francs. Then the 90 is after 61 months. And then the 120 is after 82 months. So you see it goes faster and faster and faster. 9 months, 2 years and 8 months, 5 years and 1 month. And the 120 is 6 years and 10 months. So the traction is really going faster and faster and faster. And okay, the line isn't that clear, but that's because, of course, of the rounding differences and the fact that every share costs 30 Swiss francs. But you can see the trend, and it's definitely exponential. And then when you look at this graph, when you first start, of course, all the things that you paid in to the first month comes from your own contribution. No dividends are playing a role yet. After 5 years, it's already 9.4% of the total amount that comes from your dividends. After 10 years, it's 18.5%. After 15 years, it's 26.9%. So you see it's increasing more and more, and more rapid, or more rapidly. I don't know how you should say that in correct English. And after 20 years, 34.6% compared to 65.4. And after 30 years, it's 51.9% compared to 48.1. So here you can see definitely that the sooner you start, the better. And my wife and I, we started fairly late, but yeah, better late than not. And the thing is, I actually started when I was 14, but when we bought our first house in Belgium, yeah, I withdrew all the money from the stock market and I used it to buy the house. It was a really good investment. We doubled our money in the house after 6 years, so I don't think the stock market could have beaten that. But of course, I stopped the compounding there, and after buying that house, 7 years later, we bought a second house. So again, we did the same thing. And then when we moved to Switzerland, we did again the same thing. So thereafter, we started from scratch once again. And luckily, now we are on track and we don't need to buy a house anymore because we have one now and we can continue with SGPX and all the other ETFs that we are buying. And I hope that we will be soon here. But yeah, we are increasing our contributions as well from last year on. So then, of course, it's going to take a little bit longer to reach such numbers because when you increase your contributions, the dividends don't follow directly. Okay, the dividends increase directly, but the percentages are still small from those contributions. So, and when you look at all those numbers, that is why I hate videos like the first 100k is the hardest, and the way to 1 million is much easier after the first 100k, because the first 1,000 Swiss francs is also the hardest. The first 10,000 Swiss francs is also the hardest. It is just the way it is. So as you are able to save more and the dividends increase, the dividends become a larger and larger part of what you can contribute towards your portfolio. So it's just a mathematical thing. And when you look at those videos, it's really depressing when you just start out with 300 Swiss francs every month and they are talking about 100k, because that 100k is far, far away for you. As you saw in the table, I'm going to look it up. The 100k is exactly where is it here, attainable in month 225 in these calculations. And I know the calculations that I made is surely the minimum that you can expect, so normally it should be faster, but knowing that you almost need 20 years to reach the 100k in the worst scenario that your stocks and your ETFs that you invest in don't bring more growth beyond the 4% dividend yield, yeah, that's really depressing. So the only thing that you need to know is that saving is hard, and even when you only can save 300 Swiss francs, it's great. You will get there. And also the fact that when you are on your way towards the 300 Swiss franc extra dividend payment every month, the 200 Swiss francs that my wife and I are earning right now, it's 212 Swiss francs right now that we earn every month in passive income, if you can call it passive income, because a lot of people will disagree that I call it passive income. But 200 Swiss franc extra in dividends, it's great, because we went from 300 Swiss francs to 500 Swiss francs every month that we can contribute towards our portfolio, and this is increasing our dividends as well. And then of course, you know that since the end of last year, we are able to invest more, and we are really happy about that. So with the promotion that my wife got and the change of work that I did recently, yeah, we are contributing definitely more. It's around 900 Swiss francs, and sometimes like next month it's going to be 500 Swiss francs more. So that's really great. So 1,400 Swiss francs contribution in 1 month. That was unthinkable a few months ago. So with that being said, thank you for watching and see you on the next video on my YouTube channel. Bye.